what we're going to be going over here is pension plan gains and losses, and we're going to be calculating and recording the basic types of these gains and losses. And first we're going to be looking at the minimum gain or loss amortization using the quarter approach here. And then secondly, we're going to be looking at the expected versus the actual return on the plan assets here. And then thirdly, the projected benefit obligation. We're going to look at an increase versus a decrease here and how we would record these gains and losses here. Okay, so let's go on. Let's start with this quarter approach, and this is where we're going to calculate the minimum amortization for any gain or loss here, and that's going to be based on this is how you lay it out here. We're going to have our projected benefit obligation versus our plan assets, and what you have to do is you have to calculate the quarter amount here, or the limit amount that you're going to have to compare your net gain or loss for the year here. So what you do is you take 10% of the larger amount here of the projected benefit obligation versus your plan assets. And just looking at year X1 here, the larger amount would be the $4,000 here, or everything is in thousands of dollars. This would be like $4 million here, but let's just say it's $4,000 here, and versus our plan assets of $3,800. So the larger amount is our PBO here, or 10% of that is going to give us a quarter limit here of $400. So this is going to be our plus or minus 10%, and we're going to compare that to the net gain or loss for the year here. We're actually going to be looking at year X4 here. We're going to skip down here and we're going to look at how we calculate it. But just looking at our net gain or loss, that's at the end of the year here in a gain or loss. And we have for the year here, these PBOs and these plan assets here, those are based on as of the beginning of the year here. So this is what you have to do, is you have to look at what you would have for your beginning of the year accumulated other comprehensive income gain or loss here. And in this case, we're going to start out with a zero amount here for the first year here. So this loss occurred at the end of the year here, but our beginning of the year accumulated other comprehensive income gain or loss is zero. So for the year here, we're not going to have any amortization of any gain or loss, so it's zero. But let's move down here to year X4 here. So this is what you're going to do here is we're going to calculate our quarter amount, and we're going to compare it to the beginning of the year other comprehensive gain or loss here of other comprehensive income. And what we have to do is the difference here, we're going to make that comparison, and then we're going to look at what we have to do is we take the beginning of the year accumulated other comprehensive income, any gain or loss, and we subtract out, compare it to our quarter amount here of that plus or minus 10%, and then we divide it by the average remaining service life, and that's going to give us the minimum amortization of gain or loss. So let's look at year X4 here. We got a beginning of the year, we have $744,000 here at the end of the year here for our accumulated other comprehensive income. So how do we get that here? So what we would do is we take the previous year here, the end of year X3 becomes the beginning of year X4. That was $734,000 here. And we got that by going through year X1 and year X2 here. But to get the year X4 here, our other accumulated other comprehensive income of $744,000. What we would do is let's just go down and look at that. We take the beginning amount here, $734,000, and then we subtract out what we already amortized, and in this case it was a $12,000 loss here. But we add in the net loss, a net increase in loss here for the year of in the end of year X3 here of $22,000 here. So that's going to give us other comprehensive accumulated other comprehensive income of $744,000. Compare that to the calculated quarter amount here of $720,000, and then you divide it by the number of service years life, average remaining service years for the life of the employees here. So the difference, $744,000 minus the $720,000 here, your quarter limit, divided by 12 years is going to give you 2 here, or 2,000 here for the minimum amortization gain or loss. Didn't want to skip through here, but we just wanted to look at how we calculate any amortization of a minimum amortization of any gain or loss based on the difference here between our projected benefit obligation and our plan assets and what we calculated as our quarter amount here. Okay, so we've made our calculations here just remember you have to compare your calculated quarter amount here to whatever your accumulated other comprehensive income would gain or loss for the year here. And that accumulated other comprehensive income gain or loss here is based on the ending amounts that you have here in the previous year here. Whatever for your amortization here, you would be subtracting that here from the what you have for your to determine what your let's just go down it here. You take the $734,000 here, and then you would be subtracting the minimum amortization from it here because you've already amortized that amount. But you'd be adding back. In this case, we had an additional loss here of $22,000 to come up with the $744,000 here of the other accumulated other comprehensive income that you have to calculate compare to your quarter amount, and then again just divide it by the number of remaining service years here per the employees here, and that'll give you the minimum amortization of any gain or loss. Okay, so this is just using the quarter approach here. Now let's go and let's look at how we'd record this here. Okay, moving over here, this is, I'm not showing all the accounts. All I'm going to show here is our pension expense, and that's for the annual expense here on the pension plan. And then we're going to have this other account here, other comprehensive income. That was we have our gains or losses here, and that's an equity account here that we have to deal with here. And we're going to have looking at three different types of those gains and losses that we're looking at here. Okay, so let's start out with first our actual return here on our investment here. This is the case where you take your expected return on the pension plan here and compare it to the actual return here. So what we would do, in this case, we're going to have a loss on this return here. So let's just take a look at it. We have our expected return here of 100 or 100,000, let's just say, and our actual return here was 80,000. So the difference is going to be an unexpected loss here of 20,000. The key here is when you're recording this pension expense here based on your return here on the plan assets, what you're going to do is you're going to reduce your pension expense here by the total amount of the expected return. And then in this case, we have to break it out here. The actual return here was 80,000. We would credit or reduce our pension expense by that amount here. And then for the loss here, because we have to include that total 100,000 here as a reduction to our pension expense, we have to break out the loss here. It's going to be a credit amount here or a reduction on our pension expense here by $20,000. And that it sounds unusual here as an unexpected loss, but you'll see why here. So our return loss here, credit it by $20,000, but what you would do here, the debit amount here goes to the other comprehensive income, the gain or loss here, credit or debit or reduce your other comprehensive income by $20,000. So the key here is when you see this unexpected loss, you're going to reduce your other comprehensive income and debit amount, so the balance is going to go as a credit, the balancing amount goes to a credit in your pension expense or a reduction in your pension expense. Okay, but had it actually been a gain here, let's look at that. Our pension expense, let's say it was a gain here. We had an unexpected gain here. That is our expected return was only 80,000. Our actual return 100,000. So we'd had an unexpected gain. So in that case, you would be debiting your pension expense here, and the credit would be for the total expected return of 100,000, but you'd be debiting for a gain here of 20,000, and then the credit would go to other comprehensive income. So that makes sense here. You would be increasing your other comprehensive income for the gain here of 20,000. But we just showed an unexpected loss. But that's how you have to deal with this actual return versus expected return. Just remember, for a pension expense, you're going to reduce it here or you're going to credit it here for whatever the expected return is here. And then the balance, actual return, if it's a gain or loss, the balancing amount here is going to go to either debit or credit. Okay, so we've taken care of our expected versus our actual return here, and they're called unexpected gains or losses here. And in this case, we had that unexpected loss here of 20,000 or 20. Okay, so let's go back here. Now we're going to have to deal with our amortization amount here for the year here, the gain or loss. And we for year X4 here, we amortized the 2,000 or 2 here as our total loss here. Okay, so where does that fit into our other comprehensive income and our pension expense. So in this case, well, first off, we're going to debit or increase our pension expense for this $2,000 or $2,000 loss here. It is 2 here. And then the credit would go to other comprehensive income. We'd increase our other comprehensive income here by $2,000. So that, it may not, I guess the key here is to reference the pension expense item. That makes sense here. So you would debit or increase by the minimum amortization loss here at $2,000. It means you increase your pension expense. And that's how you come up with it. And if you got a debit, you increase your pension expense here by 2 or 2,000 here, then you know the credit has to go to other comprehensive income. Credit here, increase your other comprehensive income based on that, on your increase in your pension expense. Now, if it was a gain here, then you would credit or reduce your pension expense here, and then the debit go to other comprehensive income or reduce it by, in this case, 2,000, let's say, if it was a gain here. Okay, so you understand what's going on here. Just remember here, what you're doing here with this quarter approach here is you can see that you have a very large accumulated other comprehensive loss here of $744,000. But by amortizing it over those, in this case we had 12 years here, the $744,000 versus the limit that we have, that we calculated that corridor limit, we were able to amortize that loss down to 2 or 2,000 here. So that is our minimum amortization of any gain or loss. In this case it was a loss, so you credit or your other comprehensive income here based on the fact that you would debit or increase your pension expense. And then if it was a gain, it would be just the opposite here. Credit or reduce your pension expense, debit or reduce your other comprehensive income. Okay, so we've taken care of both this actual return here and also how it fit in here, this a minimum amortization of any gain or loss here using the quarter approach. So you see what's going on here. Just look at your debits and credits when you're looking at your gains and losses here. Okay, and then finally, let's go down here. And this is the case here where we're going to have to deal with the projected benefit obligation. That's our liability account. We're keeping track of this pension plan here, and our plan assets, which is an asset account here. But all we're going to look at here is the case where we're going to have an unexpected loss in this case, but we can look at it as an unexpected gain here. And what we do here, this is how we're going to work with this here. So remember, what you have to do in this case here, this is going to be an actuarial loss here, and we're going to increase the liability on this pension plan. So what you do is, if you went back and you looked at our end of year X3 here versus the end of year X4. Again, everything is based on year X4 that we're trying to calculate here. So our end of the year X3 here, the pension benefit obligation was $5,900, and then end of year X4 we had $7,200. But we're going to come up with the fact that we're going to have to make increase in our liability here, because all we had in this example, we had some service cost here and some interest cost, and adding those to our end of the year X3 balance, we're still going to have a deficit here, a credit or increase in we're going to need a increase in our pension benefit obligation here to bring us up to the end of the year amount here of $7,200. So let's just say our plug amount here, and we're going to have 50 or 50,000 here, and that's going to be a change here in our estimated pension benefit obligation, and it's unexpected loss in this case because we had to increase our pension benefit obligation here by 50,000. That's going to be a liability increase here of 50,000. So what we would do here, let's go up and look at it. This is the case here with this when you're dealing with these unexpected gains and losses here to the liability and your projected benefit obligation, you go directly to your other comprehensive income here, any gain or loss. Remember, other comprehensive income is part of equity. So remember, we had the credit down here. We increased our projected benefit obligation, our liability here by 50,000. So the debit goes to other comprehensive income here of 50,000. So that's how you're going to come up with your other comprehensive income here for any actuarial or estimated changes that you're going to make in your projected benefit obligation. Say, for example, let's go back down here. Now, had we had a gain in our projected benefit obligation here, say it was instead we have to have a balancing amount from the 5,900 to get up to whatever we would have had here. We would have had to debit or reduce for a gain, we would have debited or reduced our projected benefit obligation by 50 here. So debit that here. So what would happen up here? Well, then the credit would have to go to increasing our other comprehensive income by 50. So not to confuse everything, but that's how it works here. So you have to look at your end of the year amount here, or beginning of the year X4 here, end of year X3 here would be beginning of the year X4 here versus your end of the year X4. What's going on during that year? You come up with any increase or decrease in your liability, and that goes directly to your other comprehensive income as a debit or credit balancing amount. Now, you notice I wasn't working with our plan assets here. I just got the numbers thrown in here. But I'm just showing here for our, in this case, the PBO increase in our projected benefit obligation here was an unexpected loss. So we credit or debit, and reduce our other comprehensive income by that amount. But what we want to look at, remember we went over these three different gains and losses here and the different possibilities here. But what you want to do here with this other comprehensive income, remember for any gains or losses as equity here, you're just going to net out your debits with your credits to come up with the current year gain or loss. So what you would have here, just they can balance each other out here. Maybe my numbers aren't exactly correct, but I'm just using an example here for your debits and credits to understand what's going on. So let's look at it. We had this a return here on our loss on our return here, unexpected loss on the return on the plan assets here. So we debited or reduced our other comprehensive income. Then we had that amortization here of the minimum loss here. We credited or increased our other comprehensive income by that amount. And then we had the unexpected loss here, or increase in our liability to projected benefit obligation. So we debited that. So netting out everything, our current year gain or loss was $68,000. $20,000 debit here, credit of $2,000 here, and a debit here of $50,000. So net amount here for year X4 on other comprehensive income in our equity, we would reduce that here by $68,000 based on our calculations here for gain or losses. Okay, so that's how you're going to deal with them here. Just remember, you've got these three basic types here. We have to look at our expected return versus our actual return to determine if we got any unexpected gains or losses. And then just remember here how you make your credits and debits here. So always with the expected, with that expected versus the actual return, the expected return, you would always credit or reduce your pension expense by that amount here. But then you would, whatever that is, if you had a gain here, then you would debit. Say, for example, we had the expected return of $100,000, but we had we had a gain here. Just say then we would be debiting it for the $20,000 gain here. But in this case, we have all our expected return here of $100,000. Our actual return is $80,000. Expected return total amount here would have been $100,000, $80,000 plus the $20,000. But the loss here would credit or reduce our pension expense here. Doesn't make sense here, but if you look at the other comprehensive income, you would debit or reduce your other comprehensive income by that amount here for that loss, then it makes sense. And then remember the minimum amortization of any gain or loss based on that quarter calculation here. Just remember here, any loss here, amortization of loss here would debit or increase your pension expense. Therefore, you would be crediting, the balancing amount would go to credit your other comprehensive income. That would be the guideline there. And then the opposite true here if you had a gain. All right, and then finally here for any changes in our projected benefit obligation due to some actuarial estimates. We actually made some estimates here. Then remember, if you had an increase or unexpected loss, you would credit or increase your projected benefit obligation, and then the balancing amount would go through other comprehensive income here as a debit or reduce your other comprehensive income. And then if it was a gain, it would be just the opposite. Then you would have debited or reduced your projected benefit obligation if you had any gain or increase in your estimate here, and then you would have had to credit or increase your other comprehensive income for that amount. Oh, and maybe one other thing here, when I talked about this actuarial estimate here, I didn't mention the benefits here. You have to look at your debits and credits here. You have to look at your end of the year, the beginning of the year X4, end of year X3 amount here, and you'd have to look at that and compare it to the end of the year X4 and how you got to that here. In this case, we actually had a debit or reduction here and a projected benefit obligation by $40,000. I didn't show that here, but all you have to do we added up our debits and credits here, the actuarial amount here was a plug here between whatever you had in your service costs, your interest costs, and your benefits out here. And then you had to look at your beginning of the year X4 here versus the end of the year X4 to determine if you had any actual gains or losses. In this case, it was unexpected loss, increase in our liability here, and that a credit amount here, that would go to debit or reduce our other comprehensive income. Okay, so we looked at our 3 pension plan gains and losses here, and we briefly went over that quarter approach, and then we looked at how we amortize any gain or loss on that, and how we record it here as a pension expense and other comprehensive income. And then we also went over our unexpected versus our actual return here, and then any increase or decrease based on some new estimates in our projected benefit obligation as a liability, and how that affected our other comprehensive income. Okay, so that'll summarize our topic.